All right. Hello, everyone, and welcome to our monthly webinar. My name is Justin Cooper, and I'm a hard money lender and full-time real estate investor. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs, title insurance, or we may simply interview our expert friends and dive deep into how they got started, where they're investing has taken them, and what they see coming both for themselves and for the industry. I want to say a quick thank you to everyone who made it to the webinar tonight. I know that you're giving up some of your valuable time, and I'll do everything I can to bring you the value that you're hoping for tonight. Now, this webinar is brought to you by Pine Financial Group. Pine Financial is Colorado, Minnesota, and now Wisconsin's premier hard money lender. Pine focuses on the needs of Colorado, Minnesota, and Wisconsin real estate investors. We are investors ourselves, and we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, tonight's webinar brings in a special guest, me. Since I am a full-time hard money lender, and we haven't really chatted about hard money recently, I wanted to dive in, and actually we put together a new presentation. This one is called The Myths and Mysteries of Hard Money Lending, dispelling the rumors to get all the financing you need. So that's me, Justin Cooper, and my contact information. And so what we're gonna do tonight is dive in a little bit to what are some of the questions, the commonly asked questions we get here at Pine Financial. What are some of the concerns I see, emails I get? What do we see on the internet? Hard money seems to be intimidating to some people. And so we want to talk about that tonight, why people are nervous and scared, and why maybe they're hesitant to pick up the phone and call and just start chatting about hard money. So before I get too far, if you're in Denver, I want to bring something up here real quick. We are hosting our Real Estate Investor Success Summit coming up on October 20th. So I hope you all mark your calendars. This is by far the biggest and the best real estate investor event in Colorado. In years past, we've had anywhere from 300 to 500 attendees, 20 to 30 vendors. All the speakers are local. There's no sales pitches. It really is the best event out there. So mark your calendars, October 20th. It's coming up quick. You'll start seeing some emails coming through about how to register. And if you don't start seeing those, feel free to reach out to me. I'm happy to get you on the list and tell you all about what that looks like as we get a little bit closer. So here are some of the big myths, mysteries, questions, things I hear about hard money. Hard money lenders don't care about their borrowers. Hard money loans should be a last resort. Hard money lenders are loan sharks. They're difficult to obtain. Interest costs are huge. Hard money loans are for desperate borrowers only. It's expensive. The hard money lenders make risky loans. The list goes on and on. And so what I wanted to do is dive into these one at a time, ask the question, and then dive into what the real facts are, what the truth is on these myths, mysteries, questions, and hesitations. And so, of course, as we're going, if you have any questions of your own, if you want me to expand on any of this stuff, we're using the questions section on the webinar. So feel free to dive in, throw a question in there. I'm watching it as we go. And as I see any questions that make sense and will be beneficial to the rest of the group, I'm certainly gonna stop and dive into those questions and make sure that you're leaving not just with the info I want you to have from these slides, but any other questions that you guys might have. I broke it down into a couple sections. So first one, I'm calling lenders, and I'd love to get your feedback on this presentation. So if you feel like there's other ones we should add, shouldn't add, a different way to do it, again, this is the first time we've put this together, so I'd love to get some feedback from you. So this first section is kind of around what are the myths and mysteries, specifically around the types of lenders. First one, hard money loans are called that because they're hard on your wallet. So this one is kind of just generic, right? How does it even get their name? And this one actually is a myth or a mystery that I usually talk about. I call these things hard money loans because they're hard on your wallet, right? Let's get it out of the way up front. Hard money loans are not the cheapest loans out there. But in reality, they're hard because hard money loans get their name from the asset class they're generally made against, okay? They're made against real property. That's what we're talking about tonight, right? Fix and flips, rental properties, new construction projects, getting hard money for those types of investments. And those types of investments entail a hard asset, real property. And that's how a hard money loan gets its name, because a hard money loan is based on a hard asset. It has nothing to do with the cost or anything else. It's actually a lot simpler than I think most people think. Hard money lenders are loan sharks. I hear this a lot, probably more on the internet than anyone, coming and saying it to my face, although that has happened before. Hard money lenders are loan sharks, so I definitely disagree with that. Loan sharks, I actually looked this up just to be sure. Loan sharks charge illegally high interest rates. So hard money may have higher interest rates, but they're certainly not illegally high. And then loan sharks threaten violence to collect the debt. Now, Travis in our office did have a tire iron sitting on his desk for a while there, but I think that was more because he had to change a flat tire on his car, not because we were trying to collect payments or anything. So, in reality, hard money lenders are typically very successful business people, businessmen, businesswomen, business people, uh, and or real estate investors with extensive experience in real estate and finance. Okay, so we're not out there just trying to make a quick buck. We're not calling Cousin Vinny or anything like that. We're in it because we love real estate and we love finance and we want to see people be successful. That's what really most. I can't speak for all hard money lenders. It takes all different kinds, but speaking from my experience, both with what Pine Financial does and everybody here in our office, as well as the hard money lenders I know, we are uh, business people and real estate investors. And that's why we're in this business. Hard money lenders don't care about their borrowers. I've heard this a lot. We may bring this up in different forms throughout the presentation. Hard money lenders don't care about their borrowers. I actually think that this is the opposite. Most hard money lenders actually care deeply about their borrowers and want nothing more than to see them succeed. So this is actually something so near and dear to us at Pine Financial Group. It's actually in our tagline, working together so you succeed. We want to make sure that our borrowers are set up to succeed. We want them to be successful, get a great deal, make a bunch of money, and then come back and do it all over again. That's the point. That's how we all got where we are here in the office, by doing multiple deals and working with good, safe lenders. And that's what we want for our clients. We want to see them be successful. So hard money lenders look closely at the borrower to make sure that they'll be safe when things potentially go wrong on their project. So again, we'll talk a little bit more about this as we get going further along in the presentation. But what we're talking about here is making sure that we're not going to set you up to fail, right? I do look at my borrowers. I do want to know how much money they have in the bank and some other things like that, because I want to make sure they're going to be successful. We've done enough deals and transactions, both personally and as lenders. I think we've closed over 1,300 loans now as Pine Financial Group over the past 10 years. We're about to celebrate our actual 10-year anniversary this year. And collectively, I think we own over 50 rental properties individually here in the office, if you add up each of our portfolios. So we know what investing looks like, and we want to make sure our borrowers are successful. And a lot of what we do is sharing our experiences, both as our personal investments and our other clients. Alternative lending is unregulated. So a lot of times hard money is looked at as alternative lending. It's not the mainstream, traditional, conventional Fannie Freddie type stuff. In fact, hard money lenders may not have the same capital requirements as banks, but they still adhere to federal and state lending regulations. That's absolutely true. Hard money lenders must still be compliant with contract law, other types of law, Here in Colorado, we have the Department of Regulatory Agencies. We've actually had them come into our office a couple times and just chat about what we're doing and how things work, just making sure that we're treating our clients fairly. So absolutely, we are regulated. There are people looking over our shoulder, and if you haven't talked to us before, hopefully after this, you'll feel that we are doing everything we can to really take care of our clients and make sure they're going to be as successful as possible. Hard money lenders make risky loans. Now, this one, you might think they do, right? Lending on real estate investments. And certainly anybody who's not in the industry or investing in real estate may feel that. But really, the opposite is true. And why is that? When professionals like us, hard money lenders, right, experienced investors and business people, underwrite the deals and the borrowers, they're making sure that the risks are minimal for a couple of reasons. First, we have our money at risk. We want to make sure that our loans are safe, that the investors will be getting a good, safe return on their money. We want to make sure our borrowers and clients are in safe, profitable deals. So again, they have success, make a bunch of money, and come back and do it all over again. One of the reasons people work with hard money lenders, especially as they're getting started, if they haven't done a lot of deals, one of the great things is working with a hard money lender, because these are professionals who are out there all day, every day, looking at tons and tons of deals. Nobody really knows, I think, the market better than a hard money lender, because they're seeing all aspects of it, all different price points, different neighborhoods. The good hard money lenders are in that market all day, every day. And they're going to do what they have to do to make sure that you're successful. And so if you're a newer investor, it might make a lot of sense to go and use a hard money lender, because you're going to have that third party verification of what you're thinking. You're going to be able to bounce ideas. You may meet them at your project and say, hey, what should I do here? I'm thinking about opening this wall. Or, hey, what are the paint colors your clients have been using? Or, hey, I just want somebody to double check the way I'm underwriting the deal and crunching the numbers. Here's my purchase price, my repairs, my after repair value. What do you think? Here's the math. Here's how I analyzed it. And so having them as a trusted source will actually greatly reduce the risk of these deals. Hard money lenders like to foreclose. I do hear this, and unfortunately, there are some lenders that I've heard of that do something we kind of refer to as loan to own. They make the loan fully intending on foreclosing on the property and taking the property over. Most lenders are in the business of making good loans, not taking properties back. It's actually more expensive, time consuming, and less profitable for a hard money lender to take a property back than to just make a good loan to a good borrower. If we wanted to do a deal ourselves, then we would go and find a good deal. We have great relationships with wholesalers, with real estate agents, with property managers, people that can be feeding deals to us, that if I wanted a deal or somebody else in our office wanted a deal, we would just go out and do it. We're not going to try and cheat a borrower, a client, another investor. We're just going to go find our own deals and do them. So there are some lenders who out there who do this. We certainly aren't any of them. I think you can talk to anybody who's ever done business or even chatted with us. Most hard money lenders out there are the same as us. They're out there to make good loans to good investors, and they make their money on the points and the fees, and that's what they're happy doing. So, but just be aware, make sure you're doing your diligence on hard money lenders. If you're out there chatting with some, make sure you're asking good questions, maybe asking around who else knows them, what kind of reputation they have, and maybe we'll be able to sort through some of that stuff. But no, generally speaking, hard money lenders do not like to foreclose. Hard money loans come from predator and dishonest lenders. So there are some lenders that purposely make bad loans simply to get the fees and then the property, right? This is kind of what I was just talking about. But In reality, hard money lenders are typically successful business people with extensive experience in real estate and finance, right? I'm kind of repeating myself here, but sometimes there are different thoughts. They may be similar, but slightly different. And so I just want to make sure we're addressing these different myths that I've been hearing and seeing. I want to make sure I address as many of them as I can because someone may hear that the answer to one thing, but they still have this other one in their head. And I want to make sure that we're very clear that most hard money lenders are not predators. They're not dishonest. They really truly want to see their clients be successful. So how am I doing? Let's get a little feedback here in the questions section. Am I going too fast, too slow? Am I at a good pace here? What do you guys think? Anybody? There we go. A little slow. You want me to go faster? Okay. Doing good, a good pace. All right. Well, we'll see how we do. We'll keep going here. All right. Let's jump over to some loans. All right. Let's dive deeper onto that. Private money is cheaper. How often do we hear that? I hear it all day, every day. Whether I'm at an event, whether it's on the phone, whether just talking to other investors out on a job site or whatever it is, private money is cheaper. The fact private money probably is cheaper. It's kind of hard to argue that. That's one of the great benefits of private money. That's why people go and try and find private money and they try and manage their private money lenders. That's why there's books and courses and all kinds of information on how to get private money. But if we dive a little deeper, private money is hard to find. It's not as visible as hard money. The private lenders are just that. They're private. They're not out there. They don't have websites. They're not going to real estate investor meetings. They're not setting up tables and advertising themselves as private lenders. Private lenders are private. It could be your doctor. It could be your uncle. It could be the person behind you in line at the coffee shop. They're private people. And so they're not easy to find. They can certainly be less reliable. And unfortunately, maybe unfortunately for the real estate investors, fortunate for us, we get calls all the time. I actually had two just this week. It's only Tuesday, where an investor was getting ready to close on the loan. They had some private money, and then at the last minute, their private money lender backs out. I literally just talked to someone 2 hours ago that said their private lender backed out 15 hours before closing. They had been under contract for weeks, building the file, doing their diligence, talking through everything. 15 hours before closing, the private lender backed out because they didn't have the money. They couldn't get to the closing table and fund the deal. I can't tell you how many times I get a phone call where the private lender does fund the deal. They do cover the purchase price, but when it comes time for that repair money, a month, 2 months, even just a week later, okay, hey, Mr. Private Lender or Mrs. Private Lender, I'm ready for my draw. And they're like, wait, oh yeah, that's right. You needed some money. Oh, well, somebody else had a deal and I funded that. I didn't think you needed the money this fast. And now your project stalls because your private money lender ran out of money. Huge risk. And I unfortunately get calls like that all the time. And then depending on how large your business is getting or just how you're managing your projects, how liquid and large your private lenders are, you may have multiple private lenders. And each one may need a different level of handholding. Some may want to come out to the project daily, weekly, and check in on you and maybe give their thoughts. Oh, well, I think we should do this. Well, it's not their investment, it's your investment. They're simply the lender, but they may want to be giving feedback. So you have to manage that. You may have to manage the different types of financing that they're giving you. Each lender may have different terms, different pricing, and you can actually spend a lot of time managing all of that instead of focusing on your deal. So when it comes to hard money, yeah, maybe we're a little bit more expensive, but when you factor in how much time it takes to find the lender, to make sure that they have the cash that they say they do, to not have to manage your private lenders as much, all of a sudden the time you're getting back and the less effort you're giving to your lender, it actually might make up that difference in the price. Just something to think about. Traditional loans are less expensive. So traditional loans, I'm talking about like conventional loans, Fannie Mae, those types of things. Yeah, That is true too. The rates are lower. Hard money is going to be closer to, 10, 15, 18%, where conventional loans are 4, 5%. Maybe a bank might be 6% interest. But really what we're talking about here is apples and oranges. So most investors, especially someone who might be interested in hard money, is looking at your cash on cash return, right? How much cash do I have going out versus how much cash do I have coming back in? So the less cash into the deal would be a higher return on investment. And so this is one of the reasons that people go with hard money lenders, because you can get much higher leverage, which means you can borrow more money, which means you'll have less money out of pocket. So if the rates are a little bit higher with hard money, maybe the cash back in at the end of the project is a little bit less. But if you have substantially less cash out of pocket, your return on investment is much higher. If you only have a set amount of money in the bank that you can invest, and you were looking at maybe going with a conventional lender, you may have 20, 25% down just on the purchase price only, right? Because they'll only do 75, 80% loan to value, and their value is the purchase price. And then any repairs will be out of your pocket as well. So you'll have potentially substantial amounts of money out of pocket to try and chase that 5% rate or whatever it is as an investor. Whereas the hard money lenders, they'll leverage higher. They may lend based on the after repair value, not your purchase price. And so with that, they may lend a lot more. Some lenders will lend up to 90%. Some lenders will lend up to 100%. So if they're lending 100% of your purchase price, you're saving that 20% down, right? A lot less cash out of pocket. Some lenders will lend repair money as well. So if you're borrowing that, that's less money out of your pocket. So again, the cash on cash returns start skyrocketing when we're looking at hard money lenders. So depending on the scale that you want your business to take, if you want to be doing more than one deal at a time, if you want to be doing more than 5 deals at a time, hard money might be the best fit. Now, I mention this, and I'm certainly mentioning these other types of loans because hard money is not necessarily the end all be all. Okay, so what we're looking at for hard money is it's just a tool, right? If you were to look at all the different ways to finance it, right? Say you have a financial tool belt, hard money will be a method of financing, right? So you want to find the right screwdriver for the right screw. You want to find the right lender for the right deal. Okay, so it's a matter of matching these things up. So some deals, traditional loans might be better. If you have access and can manage your private lenders, private money might make more sense, or depending on what you're looking at, maybe hard money might be the best fit. Hard money loans should be a last resort. May have just jumped the gun on that one, huh? So a fact, highly experienced and successful investors actually look to hard money lenders as the first option. Right? We've got some clients with hundreds of thousands of dollars in the bank. I talked to one earlier today, and they have close to $1 million in the bank. And they were looking at only doing a deal where the purchase and repairs were like $700,000. And they just want to make sure that they're safe and can be get approved for that property. Yeah, of course you can. You could pay cash for it if you really wanted to, but they don't want to. They want to get a loan because they want to leverage that money. They want to have that third party hard money lender looking over their shoulder, making sure that they're running the deal correctly and the analysis correctly. They want to be ready for that next project. If they went in on that deal, could they do another deal at the same price point? No, because they'd be all in. If they wanted to do $200,000 properties, how many could they do? Yeah, they could do several, 3, 4, 5. But what happens when that sixth one comes, right? Now they can't. So maybe they'd pay cash for one, maybe they use hard money for another one, right? But now they know that they have options. And that's what really comes down to. Knowing that hard money lenders are more flexible, efficient, and lenient than traditional loans, and that they can fund in days, not weeks. Okay, so that's certainly an important thing, is the time it takes to get these loans. If we're going to be competitive in today's super hot market, closing sooner than later is certainly important. And having someone who'll pick up the phone and talk to the listing agent and tell them about your relationship is certainly important. So make sure that you're relying on this hard money lender, not just for the money that they have, but also for the other benefits, right? Making sure you're running your numbers correctly, making sure that they're doing whatever they can to help you be successful by making those calls and other things. Interest costs on hard money loans are huge, right? This is the thing we've kind of been talking about. That hard money is hard on your wallet, right? Like we talked about on that first slide. So typical hard money probably ranges from 10 to 18%, but it's interest only. So first off, that's something really important to understand. If you're looking at a conventional loan and you're looking at the 5% interest, it's not apples to apples, right? Because a traditional loan, you're looking at principal and interest, okay? And they may also factor in taxes and insurance as well. So if you just look at 5% interest on whatever your loan amount is, that's not going to be your real payment. Whereas with hard money, maybe it's a 10%, but 10% on the loan amount, that's probably going to be your actual payment. So that's certainly something to understand, that hard money loans are generally interest only. So due to the short term of these loans and the high leverage, the cash on cash return investment is much higher, as well as the return on investment on the investor's time. Like I was mentioning on the previous slide, just knowing that your hard money lender can be a lot more efficient in how quickly they underwrite the deal, how quickly they can get the money to you, make your offers more competitive because they can close quicker. There's many other benefits other than just looking at the profit dollars on a deal by using a hard money lender. Something super important to be thinking about. Hard money is 100% financing. It can be. Some hard money lenders can cover 100% of your deal, meaning your purchase price, 100%, repairs, 100%, closing costs, 100%. So Pine Financial, that's what we try to do. We try to cover everything we can, at least with our rehab loan. We want to try and cover everything, potentially making it a true no money down deal for you. Now, that doesn't mean that you don't need any money. Just because we can cover all of it doesn't mean you don't need any. So one of the biggest things there is maybe there's going to be monthly payments. With Pine Financial, there are monthly payments. If we were able to lend 100% of the repairs, but then on day one, there's a change order, well, where does that money come from? So the hard money lenders locked in their repair amount. They don't necessarily have any more money for that. So you as the investor would have to have that money, right? Sometimes just life gets in the way. I use an example of what happens if you get hit by a bus on occasions, but what would happen with that? What happens if there's unexpected medical expenses? Where does that money come from? So we want to make sure that you have some money in the bank so you can roll the punches on these deals. Again, going back to all that experience we have here at Pine Financial, we know things are going to change. It's incredibly rare that a project goes perfectly smooth. So we want to make sure that when those things happen, not if, but when, that you do have some money and you're ready for that. All right, so qualifying. It's all about the property. We hear this all the time. I'm sure you have too. When it comes to hard money, it's all about the property. Well, in reality, it's mostly about the property. But good lenders are also looking at the borrower, right? And this goes back to what we're talking about, making sure that we're going to set the borrower up to succeed, making sure that we're not making risky loans. Just because the property may be a home run, slam dunk deal does not mean it will be if the borrower is risky or if the borrower is inexperienced or there's lots of variables that can go into this. So a good deal could still be risky if the borrower doesn't have reserves, doesn't have experience, right? What if you get into the property and just something else is different, right? You want to make sure that it's a well-rounded deal, meaning both the property and the borrower are ready for it. Bad credit is okay. We hear this all the time. Hard money lenders, if you do have bad credit, go to a hard money lender. Well, reality, bad credit could put both the lender and the borrower at risk. So one of the things we look for at Pine Financial, I'm not necessarily worried about your credit score. So you may have a bad credit score, right? A lot of investors got tripped up in the big downturn. And some of them just said, you know what, I'm not going to borrow any more money. I'm just going to use cash for everything. And if you don't use credit, well, then there is no good credit score, right? So maybe you don't have a good score, but I'm going to look at your report. That's what we do at Pine Financial. We're looking at the credit report, and what we're looking for maybe tax liens, judgments, things that could actually attach to the property and put all of us at risk. So could bad credit be okay? Yeah, absolutely. But we're going to make sure that we're not going to set you up to fail, right? That we all take a very smart, common sense approach to what you have going on and make sure, again, I repeat it over and over again, but I can't say it enough, really. So expect me to keep saying it. We want to see our clients be successful. No cash is needed. Kind of already chatted about that a little bit, right? Some hard money lenders will lend 100% of your deal, but they'll require you to have some reserves. And reserves means we're going to check your bank account. So we may want you to send a snapshot of what you have in the bank. We may want one bank statement. We may say, hey, if you've got a personal bank account and a business bank account, send us what you got. We would just want to get comfortable with who you are and where you're at. Because again, there could be change orders, there might be monthly payments, maybe your general contractor skips town on you, takes a bunch of money. And then the personal issues, right? If anything, you just got to keep putting food on the table so that you have, at a minimum, the energy to get out to your project and manage your contractors and keep things moving. So, yes, money is needed. Although you can borrow maybe 100% of the deal, you got to have a couple bucks in the bank just in case. Really, really important. My exit strategy doesn't matter. Lenders want to know why they should lend you money. And almost more importantly, they want to know how they're going to get paid back. This is super important. If I'm going to trust you with hundreds of thousands of dollars, I want to know how am I going to get that back? So understanding the exit strategy is really important because different investors have different objectives. Some may want to be doing a fix and flip. Okay, well, what's the exit strategy on the fix and flip? You're going to sell the property. Okay, well, if you sell the property, how do I know what you can sell it for and thus know that the investment is safe? Well, we're going to look at the ARV, the after repair value of the property. We may look at your repair budget to understand that you're going to be doing enough repairs to the property to get to that after repair value. Now, would the value be different and would your repair budget be different if you're going to do a rental property instead of a fix and flip? Yeah, absolutely. It's going to be different. On a fix and flip, you may be doing, the granite countertops, the stainless steel appliances, and keeping up with all the latest, greatest trends. Whereas if it's a rental property, you just want it to be safe, habitable, functional. So you may be putting in some Formica countertops. You may put in some cheap, like Craigslist dented appliances, and so the different level of repair, the different quality of the property will yield different values to the property. Okay, so this is really important to understand. So if we know that going in, plan A is for me to fix this up to a rental grade and I'm going to refinance. That's how you're going to get paid back, Mr. Lender. I'm going to refinance out of your hard money loan into a conventional long-term loan. Okay, and so here's my repair budget. Here's the value with that. Well, maybe if that's the plan, if you're going to keep it as a rental and refinance, maybe your lender's going to want to know that you're already pre-approved for that refinance. That may be really important because last thing, again, they want to do is set you up to fail. What if they say, okay, great, here's the money. You can do a rental grade rehab. You can even put a tenant in there. And now there's a tenant on a 12-month lease, a year lease. The quality of the property is that, Craigslist dented appliances, and then you go to refinance it and you're denied because you wouldn't have qualified. Well, if we had all known that from the beginning, maybe we could have pivoted before you even bought the property and said, let's change your repair budget. Let's reevaluate the value. And what if we did this, approached it as a fix and flip? Can you be successful doing that? And if we know that ahead of time, now you don't have to worry about getting out of the contract. You can still move forward and make money on this project just in a different way. Or maybe we can have this conversation early enough and quick enough, and then you can back out of the contract and try and get your earnest money back and go back to the drawing board. Well, what do I need to do to get pre-approved and why was I denied? If we know all this ahead of time, we're going to be more successful and everybody's going to be a lot safer. So yes, exit strategy does matter. Documents don't matter. right? We've heard this from back in the day, low doc, no doc, ninja loans. And so that we heard that a lot in the conventional world, but here in the hard money world, right, anything goes. Well, not true. Remember how we said we want to look at our borrowers and we want to make sure that they're successful? Hard money lenders, most of them, will still review several documents, not nearly as much or as in depth as conventional lenders do, but they want to get to know that borrower. They want to make sure that we're going to set you up to succeed. So what are we looking at here? We may look at an appraisal. We may look at the appraisal to confirm that after repair value. We may look at your scope of work to make sure the repair budget is in line with your strategy. We may look at a bank statement to make sure you've got a couple bucks in there to make sure you're going to handle those change orders and whatnot. We may look at your taxes simply to know you pay your taxes. If you don't pay your taxes, then we're at risk for tax liens, right? We may look at the credit report to see if, okay, you pay your taxes, but are there any judgments? We want to get to know what was going on there. We may check your ID simply to prove that you are who you say you are. We want to look at title commitments. We want to make sure that you and I are getting clean title. Super important, often overlooked and brushed over, but getting good title commitments and understanding what's in there can be really important. So yeah, documents do matter. We don't go in, like I said, in as much depth as conventional lenders, but we certainly want to get to know you and the deal and our borrowers a little bit better. Okay, so you pay your taxes, but you're self-employed. I hear this all the time. I'm self-employed. Can I get a loan? Now, this may also apply for traditional loans, but but people are concerned about being self-employed when it comes to hard money loans. So in reality, over 50% of our clients are self-employed. And yeah, if they're our client, that means we lend to them, right? We lend to business owners on a daily basis. A lot of people may be full-time self-employed as real estate investors. They may be self-employed full-time who own their own businesses, in different industries. So yeah, absolutely. But really what it comes down to is, uh, what are you telling the IRS, right? If you don't make any money and don't report any money, then that could be a problem, right? Maybe not for us as hard money lenders so much, but if you're planning on buying rental properties and you're looking for that refinance, that might be important. If you do make money and you tell the IRS that you make the money, then yeah, absolutely, you should be able to get the conventional loans, and it's certainly going to help your cause with hard money loans. Now, most hard money lenders don't look super closely at your income. That's usually not a make or break piece of the pie, but if you're maybe close on your reserves, if you don't have much liquid in the bank, maybe we want to know if you have any income just in case, not just one of those unknowns happens, but what if two happen at the same time? And it wipes out your reserves. You have more money coming in to handle these things. So what does a good tax return look like? Well, right down here, they're claiming $128,000, from maybe a corporation, a partnership, rental real estate. They're making money. They're telling the government that they're doing good. All right, great. You're telling them you're making money. But what if you write off everything and the kitchen sink, right? Well, now you're showing that you're operating at a loss. So if something bad happens, how do I know you're going to have extra money for that? I don't know. Maybe I can't. So this is just something to be thinking about and planning. Planning ahead for your investments, for your taxes, super important. If you don't have a good CPA, let me know. We've got referrals. I'm happy to send you over to some of the folks we work with and just strategize. Maybe you don't show all 128,000, but you also don't show $100,000 loss. Maybe there's a happy medium, right? So, but it's important that you're filing your taxes and that you're staying up on what's going on and telling your lenders these things. So here's a question. Now, wouldn't reserves account for stability? Yeah, so reserves certainly help with some stability, but if you are one of those investors who has, say, $400,000, $500,000 in the bank and you're just buying a $200,000 property, yeah, I might be okay with showing very little or no income. But if you only have 10,000 or 15,000, but you make, $200,000 a year, well, that may also make us comfortable. So it's not just a hard and fast line on the reserves or on income. It's really just making sure that you are going to be safe in this deal, right? That it's going to be that we're not going to set you up to fail, right? So that's really the biggest thing. Now, I understand that some people like to pay as little in taxes as possible, but if we're investing in real estate, part of that generally is making sure that you can get a loan. So there's a balancing act, right? Pay the government as little as possible, legally, of course, but also showing them that you make enough money so that you can qualify for loans. So again, go talk to your mortgage lender if you have one, if you're planning on long-term loans, talk to your CPA and find out what that balancing is to make sure you're walking that fine line. All right, so I can just get a regular loan. Yeah, of course you can, right? That's what I was mentioning earlier. You can get a conventional loan. You can use private money. You can use hard money. These are all just different tools. But to get a traditional loan, it may require a lot more documentation, right? Months of bank statements, years worth of taxes. It takes a lot more time to get these things. I think the average time to close a conventional loan is like 49 days. So very, very long. We're hard money. We're talking days or weeks, like 2 weeks maybe, to get a hard money loan, not 6 weeks. And traditional loans may require much larger down payments. Now, if you're buying a pretty property, yeah, maybe that's the way to go. Maybe hard money is not a good fit. Maybe private money is not a good fit if you're just buying a pretty property that's going to be a long-term rental. Maybe it makes sense to go straight into the traditional loan. But what if the property doesn't qualify? What if you are trying to do a fix and flip, right? And the property is beat up and ugly. It may not qualify for a conventional or traditional loan. So you got to make sure you're walking that line and you're prepared to pivot. If you're trying to get that conventional loan, but maybe the property's beat up enough, you got to understand their guidelines of what they're looking for, both the home inspectors and the appraisers, to make sure that you can that the deal will qualify. Super important. Where really with hard money, the uglier the better. The uglier the property, the more potential there is for that upside. I'll get the best deal by shopping around. Yeah, you could, but sometimes contacting multiple parties does not get you the best deal. Sometimes what it does is it just wastes a bunch of time, especially if you're under contract on something. Now, if you're not under contract and you're just looking to get pre-approved, absolutely, you should be calling around, talking to different lenders, getting comfortable, not just with their loan, but who your contact is. Do you trust this person? Do you click with them? Do you get along with them? Do you want to do a lot of business with this person? That can be really important. But if you're already under contract and you're moving towards that closing date, and we were aggressive with that closing date because it's a hot market and we have to be aggressive, shopping around may bite you in the butt, especially if one of the first people you talk to is the better loan or has a great you just get along well with them, and then you go shop around and then you come back. How does that lender not know that you're not still shopping him and just trying to get the best deal? uh, Literally every single day can be important when you're trying to get a hard money loan because those closing dates are coming up so quick. So time really is of the essence. If you're going to shop around, do it before you go under contract, to make sure that you're not slowing things down and putting your earnest money at risk and maybe even the whole deal at risk. Higher loan to value lenders are better. I keep hearing something along these lines all the time now because it's such a hot market. It's so competitive. So lower loan to values might actually protect the borrower and not just the lender, right? People may think, oh, if you're only lending 70%, if you're only lending 65%, you're just trying to be safe, but I can't get these deals because the deals are much higher. Yeah, that might be true, but really maybe we're saving you from doing a bad deal. So tight markets make higher loan to values more desirable so borrowers can borrow more money, right? If you don't have the hundreds of thousands of dollars, if you only have tens of thousands, if that, right, you want to borrow more money. So borrowing at a higher loan to value, we're talking like if the ARV is 100,000 and you can get a loan for 70,000 or 70%, that'd be 70,000. But if you can get a 75% loan to value, that means you could borrow 75,000. Okay, which sounds great. You're borrowing more money, but you're also, all the costs and fees that lenders charge are based on that loan amount. So the higher the loan, the higher the fees, the higher the interest. Okay, and if you're borrowing higher than standard loan to values, you're kind of already telling everybody, I guess, that the deal isn't as strong as, other lenders might like. So you're dealing with a smaller margin. And then when you have higher fees, that margin gets even smaller. And next thing you know, higher loan to value loans, they sound great because you can have less money, but really what you're doing is you're cutting into that profitability. So really make sure you're crunching the numbers, not just how much can I borrow or how little down can I have, but really what's my profitability on this? How does the things change if I'm borrowing more money? I want to pay cash for the property and then take out the cash later. Pay cash now and then get a cash out loan later so I can avoid the cost of the hard money. So yeah, I mean, you can. It's possible to pay cash for a property, of course, right? But with a cash out transaction, there may be some restrictions and it might eat into your profits. So there might be a few ways you could go about that. You could do what something in the traditional world they call delayed financing. So you can take cash out after the purchase, so maybe a week or three after you're purchasing, so no seasoning, but you can only do up to 75% of the purchase price. So you're certainly not getting all of it back. You're still essentially having that 25% down payment. And if you're doing a fix and flip, you still have all the repairs out of your own pocket. You could do a cash out, but generally there's a minimum of 6 months waiting period before you can take the cash out. And after 6 months, they can probably use that new appraised value. But again, you're only going to go up to 75% loan to value. And it's probably of that new value, but you're still only at 75%. So you really got to make sure you understand the moving parts. First off, 6 months on this cash out, and then 75%, and 75% of what? So make sure that's going to be worth it for you. Sometimes it's not worth avoiding the cost of the hard money, paying a couple thousand or whatever it may be for the hard money loan, but to avoid these other things or have less cash out of pocket might be a lot more desirable. All right, just a few more general questions here. Hard money loans are only for flipping. In reality, hard money works well for flips and for rentals. And actually, we're doing a lot of new construction projects that we're financing with hard money. So hard money loans can dramatically increase both the returns and the number of rentals in your portfolio. So if buying rental properties is something that interests you, hard money is certainly an option. You don't have to just buy the pretty property and put the 20-25% down. You can borrow hard money, buy a distressed asset. You can increase the equity in the property, right? Increase the value of the property through the repairs, just like you would on a fix and flip. You buy low, fix it up, now the value goes up, and then what? Well, then you would refinance based on that new value, all right? And so we teach whole other classes just on this topic, but it works incredibly well if you're willing to buy those ugly properties and put the effort into fixing them up. You can potentially buy rental properties with no money down. It's a really great strategy. Again, it doesn't work on every property, but it's something to be thinking about. So here's a question. Are there closing costs or fees on top of the 10+% interest rate? Yeah, absolutely there might be. So generally when we're talking about hard money, we're talking about points and interest, or we're talking about what they charge, points and interest. So points are what lenders charge in origination. It's what they charge to make the loan. And 1 point is 1% of the loan amount. So generally I would say most lenders charge between 2 and maybe 5 points. And that usually comes upfront at closing when you're buying. So depending on your lender, maybe it's part of those closing costs that get rolled into the loan, maybe even. But there's still certainly the points that get charged. Yeah, there may be some other, quote unquote, junk fees like processing and underwriting fees. There might be, if you're borrowing the repair money, there might be some fees for the draw inspections. So there might certainly be other fees. It's not just the interest, but that's a great question to be asking as you're talking to your lender or lenders. ask them what kind of fees are associated with this. Won't hard money make buy and holds nearly impossible to cash flow in Colorado markets? You need an exit strategy. Yes? Yeah, absolutely. You have to have that exit strategy, just like we talked about before. But knowing that exit strategy, knowing your plan is to buy a rental property, then we know what the scope of work should be. We know what the value can be, that after repair value. And then you just got to go out and find the deal that makes the most sense. Now, something that's really important, regardless of what your exit strategies are, what your plans in investing are, whether it be fix and flips, buy and holds, new construction, you have to know what your ideal deal looks like. You have to know how much, if you're buying rentals, what monthly cash flow do I want? What's acceptable, what's not acceptable? If you're doing fix and flips, you have to know what profit is acceptable or not acceptable. I had a client I talked to the other day who was under contract and moving forward on a deal, and we crunched the numbers together and we analyzed it, and we said he's only going to make $300,000. $300,000 on a fix and flip. And for this investor, they said, no, that's not enough. They needed to make more. And I was kind of astonished. First off, $300,000 isn't enough. But then to put it in perspective, I had so much respect for this investor. They're flipping, I think it was a $3 million, $4 million property, and 300,000 was not enough. And I get it, because every month the holding costs get higher and higher, right? Very expensive hard money when you're playing in those price points. One price drop might be $50,000, if it's priced incorrectly. So knowing that 300,000 was not enough for that price point and that type of product, I respect the heck out of that. And it's really great that they knew that. So understanding what your parameters are, and then finding the right deal for it. So I would say that it's not that hard money makes buy and hold deals impossible. It's that you're not finding the right deals. The market may be difficult. The competition might be difficult. But if you know what your parameters are for rentals, knowing what cash flow you want, then you have to go out and find the deal that would match that. So if that means buying a pretty property initially, then that's what you do. If it means buying a distressed property at more of a discount, then that's what you do. But knowing what is important to you and what your investing criteria are is super important, regardless of what strategy, regardless of what kind of financing. But financing can be so important. Kind of like I think you're implying in your question, financing can make and break your deals or make them not deals. So understanding that and being able to crunch the numbers before you're buying it is going to be, maybe even before you make your offers, super important. Hard money is the same as cash. We hear this all the time. I probably tell you I hear a lot of these things all the time, but that's probably why I put together this presentation. A hard money loan is actually a loan. We call it a hard money loan because it's a loan. Now, some sellers and some listing agents might agree that hard money is the same as cash, but title companies don't. And title companies can only do what they're told, right? And they're told what to do through the contract. So if you were to write your contract as cash, you're paying all cash, and then I as a lender call up and say, hey, I'm the lender, I'm here to talk to you about this deal, they're not going to talk to me. They say, no, there is no financing. This is a cash deal. And so the buyer needs to wire all the funds. Well, they don't have it, they're getting a loan. Okay, well then we have to change the contract. So you have to do an amend, maybe an extension. And we've seen it. Now, it's not very often. Usually people just get very nervous, but the deal's still closed. But there has been a few times where the seller says, no, you said you're going to pay cash. If you have to get a loan, we're not going to do it. I'm not going to sign your amend. And the deal falls out. So, it's easy, I think, to walk that fine line of telling everybody that it is a hard money loan so that they understand. They may see the hard money as cash, but you're also telling the title company that, yes, this is financed. And so what I usually do, especially in Colorado, I know those contracts extremely well. Section 4.5.3 of the Colorado standard contract is where you can choose what type of financing. They have a couple check boxes: conventional, FHA, VA, and then other. And so what I always recommend is to disclose that you're using other financing and you write in a hard money loan. And so by spelling that out, you're saying it's hard money, so the sellers and listing agents might feel like it's cash, but you're also telling the title company that there is a loan. So that's the way I always recommend that people can walk that fine line and make their offers more attractive by offering something similar to cash, but you are still telling people that it is a loan. Hard money loans are difficult to obtain. So with the right property, hard money loans are actually easy to get. Hard money loans are more interested in the investment opportunity, right? We've talked about this over and over again. It's very much about the property. It's about the deal. And so we look past a lot of past credit issues. I'm not so worried about, if you got wrapped up in the big downturn or whatever that is. We're more interested in the deal itself. So no, it's not that difficult. There's a lot less paperwork than going with conventional loans, right? The paperwork moves faster, the hard money lenders move faster, you're getting a trusted source to review your deal. So no, hard money loans are not difficult. We've been able to build files and close deals in as fast as 24 hours because it can be pretty easy to get done. I don't want a loan because it's too complicated. Yeah, it's more complicated maybe than paying cash, but if you don't have cash, hard money loans are much less complicated than traditional loans, and maybe even less complicated than private money loans, right? The hard money lender generally has their loans spelled out, maybe even on their websites. You know what the terms are, you know what you have to do to qualify, you know what kind of documents they need, and you can get that ready and send it over quickly and easily, whereas the private money lenders may take a lot more time to get through. Hard money loans, yeah, they're low document, streamlined processes to make sure that you're going to have a great deal and you're set up to succeed, right? That's what we're trying to do. Hard money is too expensive. Going back to the same thing that everyone always talks about, right? It's hard on your wallet. The interest rates are so high. But focus on the big picture. What are we really talking about here? Are we talking about doing a deal versus not doing a deal? It may be worth, paying the quote unquote expensive hard money, right? Maybe you're going to be adding another rental property to your portfolio, and maybe it doesn't have, $1,000 a month cash flow, but maybe it still has 800, and maybe that's close enough to your guidelines. Maybe that is in your investment criteria, right? Focus on the big picture. And it's expensive compared to what, right? What are we trying to compare it to? If we just look at the interest rate, is 10% higher than 5%? Yes. But again, when we're talking hard money 10% versus conventional 5%, they're not apples to apples, right? So when you have tight closing dates, when you can borrow more money, meaning you have less of a down payment, the additional cost might be worth doing the deal, might be worth not missing out on the deal, right? Might be worth doing more deals. So yeah, hard money, I get it. People think it's expensive, but you got to look at the big picture. What are we really talking about here? Are we talking about doing a deal versus not doing a deal, doing two deals versus only doing one deal? Take a look at that big picture, and hard money is generally never too expensive. All right, so we're about wrapping up, both on the time. Look at that, right on the half hour. So was there any other questions that you had that maybe you didn't ask, you were waiting till the end? Anything that you have heard a lot that I haven't addressed? Take a quick second, drop something in the question. I can hang out for a few more minutes. I'm happy to. Oh, here's one. How often do you have a rep walk the actual physical asset before you make the loan? So we would only have to do it once. We don't do it several times before the loan. We just want to get a good baseline, understand what quality it is today so we can compare it to your scope of work and make sure that it's going to be, on par with what you're thinking that final product is, to make sure we're all on the same page with what the final value should be. So generally someone from Pine Financial would walk the property with, scope of work in hand. We'd love to meet our borrowers because we can, really help paint the picture and chat with you there. We have the appraiser walk through the deal. So yeah, absolutely. We try to get into every single deal before closing to make sure that, the investor's set up to succeed and that we got a good baseline, especially if we're going to be doing draws. We want to know what the baseline is, so that when you say, hey, we did all this work, and we know that, well, it looked like this before closing, now after closing, yep, work has been done. So do you have a way to calculate whether a property qualifies other than comps? I mean, comparable properties, that's how values are determined. We generally get appraisals to confirm the after repair value, but an appraiser is going to use comparable properties in their report. So yeah, so comps is what we do, but it's not just that for the after repair value. Then we got to know if a property qualifies, we're looking at the value, that after repair value. We're looking at the scope of work. We're looking at your purchase price. We're analyzing the deal. What is the loan amount? How liquid are you? Do you have enough in reserves? Is it going to be profitable? Let's run those numbers. So we definitely dive in. Comps are how we figure out the value. Generally, an appraiser will use those comps to put together their report. But yeah, absolutely, comps is how we come up with the value. All right, so real quick as we wrap up here, Pine Financial Group, I've been trying to talk as generically as possible, but there's certainly some other things here. So for our acquisition loan, Pine Financial has two main loans now. We've got our acquisition loan, where we will lend 90% of the purchase price, and that's it, no repair money on this one. So we do look at credit, again, the report, not the score. We want to make sure we know where that 10% is coming from. We want to make sure we know where those repairs are coming from. Again, we don't want to set you up to fail. Just because you can qualify for the 90% of purchase doesn't mean you're not going to stall out on day one when you don't know where the money for the repairs are. So we want to understand that. We'll document income. Again, we'll take a look at your taxes, but that's usually not a make or break scenario, regardless of what your income is. So if you have any questions, if you're hesitant, just give us a call, shoot us an email. We're happy to talk to you, and even take a quick look at your taxes just to make sure we're on the same page. Super easy to get pre-approved with us as well. Fast closing for the acquisition loan, we're talking days, not weeks. We can close in the name of an entity or in your personal name, and it's a 9-month loan. Our other loan is our rehab loan. And this is the one where we can potentially lend 100% of the cost being purchase, repairs, and closing costs. But we'll only lend up to 70% of the after repair value. Okay, so a couple important things there. 70% loan to value, LTV, but of what value? Of the ARV, the after repair value. And so when it comes to getting that appraisal and confirming the after repair value, that is something that the borrower would pay for. So it's usually somewhere around maybe $400. That's really the only cost before closing. Otherwise, everything else, the points and whatever other fees, it all comes at closing. It's all part of the title, why we go to a title company for closing. Similarly, credit, right? We're going to look at the score or the report, not the score. 6 months payment reserves, right? So I want to make sure you have at least $10,000 or 7.5% of the loan amount. That's what I'm looking for. And I want to make sure you have that after any out-of-pocket closing costs, if there are any, which there might not be, because maybe I can actually do this 100% loan and there'll be no money down. Again, I document income, can close fast. Usually 2 weeks is pretty comfortable. Again, we can close in the name of an entity or in your personal name. And again, it's also a 9-month loan. So one more time, if you're in Denver, keep your eye out for the Real Estate Investor Success Summit coming up. We have one coming up in Minnesota as well. I think it'll be a couple weeks after the Denver one. So keep your eye out for both of these, the Real Estate Investor Success Summit. And with that, just a couple minutes over, one last chance. Does anybody have any questions? Here's my contact info again if you want to reach out for getting pre-approved, for analyzing deals, anything really real estate investing related. I'm always happy to talk to clients or potential clients. Okay, great, perfect. So these are also used as transactional funding. So yeah, we have an option for transactional funding, also known as flash cash. Yeah, Pine Financial can do that as well. So feel free to reach out. Happy to walk through what that might look like. And so transactional funding or flash cash, that's generally used when you're wholesaling a deal. And that may be a loan that's really only maybe 24 hours long. So very, very, very short term, really just to help you maybe have a wet closing when you're doing a wholesale deal. But yeah, we can absolutely work with that. Any other questions? All right, everyone. Well, thank you so much for coming and spending your evening with me. Look forward to next month when we do another one. Thank you and have a great night.